Hello, everyone, and welcome to Financial Accounting. Today, we will continue discussing the reporting of accounting changes and errors. Today's video is the third video on this topic and will concentrate on the correction of errors. As we already discussed in the previous videos, there are three areas that require unique reporting provisions: changes in accounting principle, changes in estimates, and corrections of errors. I'm posting the link to the playlist here and in the description field. The next part is the correction of errors. Errors occur as a result of the following: 1. Mathematical mistakes. 2. Mistakes in the application of accounting principles. And 3. Oversight or misuse of the facts that existed at the time financial statements were prepared. Examples include improper reporting of revenue, accounting for stock compensation, allowances for receivables, inventories, and other provisions. Companies correct errors by recording entries in the ledger accounts and reporting the corrections in the financial statements. Corrections of errors are treated as prior period adjustments and recorded in the year in which they are discovered. Same as with changes in accounting principles, companies report the error in financial statements as an adjustment to the beginning balance of retained earnings. If a company prepares comparative financial statements, it should restate the prior statements for the effects of the error. Because net income is closed in the retained earnings account, an error in reported net income causes an error in the amount of retained earnings shown in all subsequent balance sheets. The correction, called a prior period adjustment, is shown in the statement of retained earnings as an adjustment to the balance of retained earnings at the beginning of the current year. The amount of the adjustment is shown net of any related income tax effects. You don't usually see prior period adjustments in the financial statements of large publicly owned corporations. The financial statements of these corporations are audited annually by certified public accountants and are not likely to contain material errors that subsequently will require correction by prior period adjustments. If errors are found during the audit, the financial records are corrected before they are made public. Prior period adjustments are more likely to appear in the financial statements of closely held corporations that are not audited. Let's look at an example. In 2022, Hillsborough Corporation discovered that in 2021, it overstated its accounts receivable and sales revenue by $100,000. In 2022, Hillsborough makes the following entry to correct this error. We will ignore income taxes for simplicity. Because both accounts receivable and sales revenue were overstated, both need to be decreased. Revenue is a part of retained earnings. Thus, the entry is to debit or decrease retained earnings for $100,000 and to credit or decrease accounts receivable also for $100,000. If it is difficult for you to decide whether the retained earnings account needs to be debited or credited, start the entry with accounts receivable. Accounts receivable is an asset account and is decreased by credit. Since debits must equal credits, the retained earnings account needs to be debited for the same amount. I'm posting the link to the rules of debit and credit video in case you need to review it. Let's look at one more example. Rockford Company found an error that overstated income in a prior period's financial statements. Net of taxes, the error is reported as a $65,000 reduction on the statement of retained earnings. This is what the statement of retained earnings with prior period adjustment looks like. First, we report the balance in the retained earnings as of the end of prior period. We don't include any adjustments in this number. The prior period adjustments are recorded as a separate line. Remember that the number is net of tax, as the balance in retained earnings is net of tax. Next, we report the restated retained earnings as of the end of the prior year. After that point, the reporting is the same as usual. Let's look at one more example. Assume that late in 2022, Salt Lake Corporation discovers that it failed to record depreciation on certain assets in 2021. After considering the income tax effects of this error, the company finds that net income reported in 2021 was overstated by $35,000. The beginning 2021 balance of the retained earnings account is $750,000 at December 31st, 2021. It also is overstated by $35,000. The statement of retained earnings in 2022 must include a correction of the retained earnings at the beginning of the year. Retained earnings after restatement is $715,000, which is the ending balance as of December 31st, 2021, as originally reported, less $35,000 prior period adjustment for accounting error. I hope you found this video helpful. If you did, please make sure to subscribe, hit the like button and ring the notification bell so you are notified when we release more videos like this. Thank you all so much for watching, and I hope to see you all again in the next video.